Welcome, everybody, to another episode of Smart Money Circle. My name is Adam Sarhan. Today, I have a very special guest on the show, Dave Sather from Sather Financial. Thank you, Dave, for being on the show. We greatly appreciate it.
Thanks for having me.
So, Dave, can you tell us a little about your story and background, how you got involved in this business?
Sure. Early in my life, I asked a young lady to marry me, and she had commitments in relatively small town, Victoria, Texas. And I started looking around for different places of employment. And there was a local brokerage firm that was looking to hire somebody, and I'd had an opportunity to work in the brokerage business before. And so I decided to pursue that. So I got on with a large wirehouse, not really knowing what that entailed. I had never taken an investments course before. But during that time, I learned two things. I learned that I loved the investment business, and I hated selling on commission. So for a bit of a challenging time, I cold called everybody in the Victoria, Texas phone book in the first year and was beating my head against the wall. And fortunately, I also figured out who Warren Buffett was during that time period, and that started to at least provide me a pretty good North Star to follow in terms of who I respected and how I wanted to build a business.
I love it. And that takes me to my next question. Can you explain your investment strategy or give us an overview, please?
Sure. So it's really kind of funny. Early in my career, when I was still in training with the wirehouse, they were going to send me up to New York to do some training for a couple months. And there was this older gentleman. When I say older, he was probably 70, maybe 72 years old, but he was still working. And he said, "Oh, so they're going to send you up to New York and do some of that fancy book learning." And I said, "Yes, sir." And he goes, "Look, I'm going to tell you everything you need to know in one sentence." And at that point, I kind of cringed because this gentleman was known for telling off-color jokes, and there were ladies present. And he goes, "I'm going to tell you everything you need to know in one sentence." He goes, "So pay attention." So he said, "Eat them, drink them, smoke them, go to the doctor, and look good when you get there." And you know, I must have had this stunned look on my face. And he goes, "Okay, I can see that you're a little slow. I'm going to repeat this." He goes, "Eat them, your food companies. Drink them, your beverage companies. Smoke them, your tobacco companies." He goes, "I don't smoke, but if other people are gonna," he said, "I'll consider investing in it." And he said, "Go to the doctor." He said, "So your healthcare type companies." And he said, "You're engaged, aren't you?" And I said, "Yes, sir." And he goes, "Let me tell you something about your fiance. She's going to allow the house to burn down around her before she goes out in public without her hair and nails being done." He said, "So my final recommendation is cosmetics, beauty supplies, things like that." And he goes, "If you focus your career on investing in those categories, you're never going to be the popular kid at the cocktail party. You're never going to find the next greatest technology." He said, "But what you are going to do is you're going to keep your clients in the game." And he said, that is the key to truly finding long-term, multi-decade success, is to not blow your clients up. And so, at the time, I was too young to really appreciate the wisdom of what he had said.
Right.
But then when I actually was in the business and I started reading about Warren Buffett buying Dairy Queen and being the largest shareholder in Coca-Cola, I started realizing there was an awful lot of overlap between eat them, drink them, smoke them, and kind of the way that Buffett had positioned himself and been so successful too.
I love that. And how old were you at the time when he told you to eat them, drink them, smoke them?
25.
Wow, that's fantastic. And when you went on to New York to go book study, what did you actually learn up there? Anything useful? Was it or just recycled stuff?
I learned New York was a ton of fun. I think every day we would go into the city and play. And as far as what I learned, it finally started dawning on me that the reason they hired me, even though I'd never taken an investments class.
Right.
And I was, "Why do you guys want to hire me?" Well, it's because it's a sales job. And I was so naive at the time.
Right.
I did not realize that I was there to sell product.
Right.
I was not there to analyze investments. I was not there to manage portfolios. I was there to sell. And so that is what I learned while I was in New York was selling.
So, any specific sales advice or pieces of information or wisdom that you can share with us as far as general concerned?
Yeah, so Victoria, Texas is like I said, it's a relatively small town. It's about 60,000, but it acts like it's 6,000. And
Okay.
so if you have a bad reputation, word will spread like wildfire.
Right.
And if you have a good reputation, maybe after 20 years, people will actually trust you.
That's so true.
So, you know, if you think of this business not as a sales job, but rather providing technical solutions. If you're sitting down with, a business owner, a husband, a wife, whatever the topic is, if you are there to look out for their best interest, have a fiduciary capacity, and if you will provide solutions that help them best get from point A to point B, it ends up selling itself. And so really, we need to be problem solvers. And that was really where my career finally started taking off. Instead of trying to just, sell a product, hey, the XYZ mutual fund, it's great because of, items 1 through 5. Here's the slick glossy, handout. If you actually sit down and ask people, how can I help you?
Right.
It probably wasn't too long after that. An older mentor of mine who had run the largest independent bank in Texas, he had suggested that I go through the Dale Carnegie program and suggested that I read How to Win Friends and Influence People.
Nice.
And once you ask people open-ended questions, sit back and listen, people will tell you everything you need to know to help them.
It's so true. People say God gave us 2 ears and 1 mouth for a reason, right?
Yep. Exactly.
No, I love that. That's fantastic. So almost this way to sell is by not selling, if I understand you correctly. Instead, listen, solve problems.
Absolutely.
Yep.
Yeah.
Makes a lot of sense. So when you came back from New York, you're in your mid-20s, engaged. You went back to Texas, or did your business take you elsewhere?
No, it was always with the intention that I would come back to Victoria, Texas. And so the office that we had here, it had one broker in it. It had one broker because he took care of a couple very well-heeled people.
Right.
Unfortunately, they were not my clients. I had to go get my own clients.
Right.
So I struggled with that for about 3.5 years. And then a local bank hired me to run the investments for their trust department and to start their brokerage operation.
Oh, wow.
And I did that for another 4 years. And then that was 1999.
Okay.
And I ended up, the market had gone up 30% a year for 3 years in a row.
Right.
And I sat down with the bosses and I said, I am concerned with what's going on. And they were bankers.
Right.
They were not investment people.
Right.
And so they were kind of oblivious as to what was really going on. And I said, one of these days we're going to have a really uncomfortable conversation. And they said, well, what do you mean? I said, well, the market is going to turn. It's done 30% a year for 3 years in a row. Sooner or later, with as much as that is above the norm, we will have regression to the mean.
Right.
And so I said, client's going to turn over $1 million to us. They're going to sit down for an account review. They're going to say, let's review my portfolio. I gave you $1 million. It's now down 100,000, and I paid you 10 grand for the privilege of losing 100,000. Where is the value added?
Right.
And so my pitch to them at the time was, we were taking care of the wealthiest people in the area, but I've never met a wealthy person who only has investment needs. They have taxation needs, risk management, estate planning, retirement planning, and then kind of a catch-all we call other assets. So it might be a ranch, a business, something that has a lot of big dollars and moving parts.
Right.
And I had pitched them saying that we really, to stay in front of the curve, we needed to start offering these types of services. And that would have meant probably quite a bit of difference in licensing for a bank to start, really pursuing that. They did not want to pursue that. And so May 1st of 1999, I left to start a fee-only fiduciary registered investment advisory firm.
So May 1st of 99, the market topped out in March of 2000. So you were cautious when you set up your own shop. How did you adjust your portfolios accordingly when you brought on clients?
So, that was a really interesting time. The Nasdaq subsequently dropped by 80%.
Right.
But if you were buying Budweiser and Procter and Gamble and Johnson and Johnson, big blue chip names,
Yeah.
Berkshire Hathaway was another perfect example. During the time when the Nasdaq was having its big run up, Berkshire Hathaway actually sold off by 50%, making it a tremendous value opportunity.
Right.
And being a big follower of Buffett, it made it very easy to pursue that and build portfolios around that type of holding. And so our portfolios actually did really well in 2000.
Wow.
We were actually up, and we suffered a minor loss. I think we were down like 9% in the year 2001 when we had a recession.
Oh, wow. That's fantastic considering how bad the market was.
Yeah, and that really solidified our abilities for building portfolios that were a lot more stable and that allowed clients to hang on to their money and to talk to them frankly about, are we investing or are we gambling? Because if we're gambling, go buy a lottery ticket, go invest in your internet stocks. But if we're really buying a business, let's go buy Budweiser or Procter and Gamble.
Yeah, I always joke around and say, if you're going to gamble, go to Vegas. At least there you get free drinks.
Yeah, enjoy a show before you give away your money.
Exactly. So talk to me a little about your portfolio construction and how what stocks you pick or how you allocate your portfolio in both bull and bear markets. Do you adjust accordingly? You're always hunting for value. Do you sell when things get overvalued? Just so the layman understands how you see markets.
Sure. So one problem I have always had is when people get pooled together into one fund, they lack transparency to see what's really going on and how it is impacting them. The people that we work for, we generally manage everything for them. So we manage their emergency money, their cash flow money, and their long-term growth assets. And so it is our job to ask enough probing questions to understand what are the sticking points, what is their tolerance for volatility, and what is their time frame for different assets, and then how much money can they reasonably withdraw back out of a portfolio and make sure that they don't run out of cash before they pass away. And so if you start looking at that, you recognize that there are certain volatility characteristics that accompany different asset classes. So obviously, if you come to me and you say, hey, my kid is going to Harvard in 6 months, I'm going to need this 30 grand back for tuition money. It doesn't do us any good to put it into the greatest stock idea of all time, right, just because that stock idea will experience tremendous volatility. It's just Murphy's Law.
Of course.
When you least can handle it, you will have the most volatility.
Right.
And so trying to recognize that you may not earn a lot off of a 6-month CD, but that's the right place to position that. It is a return of your principal as opposed to return on your principal. And then kind of as we look at the time frames, we'll start to add in fixed income or cash flow type items.
Right.
And then when we get to say the 5 to 7 year time frame, then we will start incorporating in the things that will produce long-term growth. So growth in excess of taxes and inflation.
Gotcha. So by looking yep, sorry, go ahead.
Ironically, we are at a very unusual time in stock market and investing history in that stocks in general yield more in dividends than the fixed income market produces in interest income.
Right.
So our portfolios currently actually have a stronger stock market equity exposure for the income and cash flow than it historically would, because not only is that dividend tax advantaged, being a qualified dividend, but if you look like since 2006, the dividend on the S&P 500 has gone up about 10% a year, which means your cash flow off of your equities is doubling every 7 years.
Yeah, that's a great point. So not only are you looking for so you basically look at the portfolio, look at the client, look at their holistic situation, look at where the money needs to go, how it needs to be invested, what the client's risk tolerances are, and their guidelines or timeframes, and then you adjust accordingly. So if a client needs their money in 3 months or 6 months, it's different than if the client needs it in 30 years or 60 years.
Absolutely.
Understood. Then when you look at value, how do you define, I know it's very subjective, but how do you find an undervalued stock? I mean, what is it? How do you define value, I guess is the question.
You know, it is a little trite, but, if Warren Buffett has often said, if you'll go back and read my annual reports, he's kind of laid it out. The problem is you got to read 50 years worth of annual reports, and then you've got to have enough knowledge to kind of know, oh, that's important.
Right.
Because there's a lot of information in there.
Right.
But I actually teach a program at my alma mater,
okay.
Texas Lutheran University, that teaches students how to analyze and interpret financial statements.
Mm.
And so there are some books that we use that are not textbooks, but, Joel Greenblatt wrote The Little Book That Beats the Market.
Right.
Chris Brown wrote The Little Book of Value Investing. And then Warren Buffett's former daughter-in-law, Susan Buffett, Mary Buffett, sorry. She wrote Warren Buffett and the Interpretation of Financial Statements. If you will read those, what you realize is the place to start is not necessarily looking at a stock's price or a stock's valuation, but rather on the balance sheet.
Okay.
You can figure out whether or not a company is going to blow up just by looking at the data in the financial statements.
Are there any...
And so my students, we have an exercise that we do on a regular basis where we take a value line page.
Yep.
And we remove the name of the company, the industry, and anything that references the qualitative aspects.
Okay.
To where all you are left with is just rows of data: sales, earnings, cash flow, dividends, debt, operating margins, return on equity, all those types of things. And the students have to go around the room and critique that information and say, this is a good company or this is a bad company, and these are the reasons why.
So what is it? Sorry, go ahead.
Go ahead.
No, keep going.
Well, I was going to say, once you learn that skill set and you limit yourself to just good companies, you have alleviated the biggest problem, which is blowing yourself up. So even if we're wrong on the timing, if we are right that we have purchased or invested in a good quality company, if time is on our side, a good company will earn its way out, even if your timing is wrong.
Understood. So just to help the audience here, if you buy a stock based on good fundamentals or good value based on your analysis and the stock price goes down, that's okay for you because of the fact that you've done your fundamental research and your timing may be off with respect to the entry price, but the analysis from the fundamental standpoint, the stock is still undervalued. Eventually, it'll go up in your favor. Is that correct?
Yes, exactly.
So just, Dave, to help the audience understand as well, what are one or two or maybe three red flags you look at when you look at a balance sheet or the income statement or the fundamentals of a company? Say, oh, you know what, this is bad or this is good. Like, how do you ascertain what's good and what's bad?
Yeah, so there is one common denominator that people can apply not only to their investment portfolios, but certainly to governments, corporations, their investments, in their own lives, and that is the debt load. And so obviously, when you are right and you borrow a lot of money, it makes you look really, really smart. But when you're wrong, it decapitates you.
Right.
And it's not just a matter of looking at debt itself. Graduate school, MBA programs, they'll sit there and they'll drill into your head times interest earned and ratios of interest versus, the total assets of the company or things like that. Those are not necessarily real meaningful. And if you go back and you study why so many companies got swept out to sea in 08, 09, it was for cash flow reasons. And so we have developed our own metric in-house that looks at the total obligation of long-term debt plus preferred stock plus pension shortfall, because that is another form of long-term debt. A lot of companies may not use debt, but they will use leases. Well, generally, you're on the hook for several years. We generally anticipate that we're on the hook for about 7 years. And then we back out the cash, and we want to divide that summation of those obligations by our net earnings. And we want to be able to pay off all of our long-term obligations, not just long-term debt, but long-term obligations with 5 years of net earnings or less. And if you are at that 5 or fewer threshold, and then you experience an 08, 09, you're able to power through on your own earnings. You're not having to rely on Wall Street to come in and throw you a lifeline, because Wall Street is very famous for lending you money when you don't need it.
Right.
And when you really need it, they're on the golf course.
Right, exactly. It's funny. That's a really good point. So just to help the audience understand, what you do is you look at the total obligations, debt, lease, anything that the company owes, so cash flow out, and then you look at the cash flow in, their earnings, whether it's retained earnings, ongoing earnings for the next 3 to 5 years, and you want to make sure the earnings are larger than the amount going out. So cash flow coming in is larger than the cash flow going out. And that's more or less the checkpoint that you look for. Is that correct?
Yeah. And that's the one that we find is the easiest. If you look at a company that's borrowed too much money, it manifests itself in other aspects. And you just realize that the second the economy does something unexpected, you have tariffs that are thrown your way, or there's a strike or whatever, you just realize you're a lot more vulnerable than you really think. And so then, probably the second thing, we'll look at return on equity and return on capital. And so return on equity is Warren Buffett's favorite metric for assessing managerial efficiency.
Okay.
So the formula is net income divided by shareholders' equity. Fancy way of saying the net worth of the company.
Right.
And so Buffett is saying, if I let management hang on to the cash, that's fine. But you've got to be able to redeploy that net profit of the company back into the company and at least produce a 15% rate of return on it. So that's, the metric we're looking for is return on equity that is consistently above 15%.
And that's annualized?
Yeah.
Perfect. So the return on equity, so cash flow, you want strong cash flow, number one. Number two is return on equity over 15% annualized. Do you go back 3 years, 5 years, 1 year, or is it just a
No, I mean, we want it to be consistent. So like over a 10-year cycle, a business has got to show us good markets, bad markets, it still can produce 15%.
Got it. And that just basically speaks to the efficiency or the skill set of the management and how well they run the operation.
Yes.
I love that. That's great. Yeah.
The problem with return on equity, though, is that it ignores the impact of debt that's introduced into the capital structure. And so to neutralize that, we will pair the analysis of return on equity and return on capital. So return on capital adds back your long-term debt into the denominator of that equation. And that allows you to identify how much in return is specifically being produced by using debt.
Right. No, that's a really good way of doing it.
And so, again, we use a 15% threshold there. And what you'll find is, obviously, a company that can produce really high rates of return with little debt is a safer investment.
Yeah, because of the fact that in a downturn, they're not going to get wiped out.
Correct. Yeah. And they have found whatever the product or service is, that they are still able to produce very above average returns.
Got it. No, that makes perfect sense. So right now it's October of 2019. The WeWork IPO just got nixed because of the fact that, I'm sure this is exactly where I was going with that. So I'm sure you're not a fan from a value standpoint of that whole business structure, taking on long-term leases and hoping to sell it up, break it up into small-term bite-sized pieces.
Yeah, so okay, so that's probably item number three in terms of things that we look for.
Right.
So Buffett sits there and he says, number one, I've got to be able to understand the company, and number two, it's got to be predictable and consistent.
Yeah.
So the other day, my students were arguing that Cisco Systems, the networking technology company, should go in their student-run portfolio.
Yeah.
And I said, okay, Buffett's rule number one is you got to understand it. Can somebody tell me why the intellectual property of Cisco is better than one of their competitors?
Right.
And, understandably, a bunch of college students probably are not real schooled up as intellectual property attorneys or patent attorneys. And so they ended up passing on that investment. So if you can't understand it, just be disciplined about it. If it's not predictable and consistent, you'll see it over a 10-year cycle. A company that consistently does well, a Dollar General or a Nike or a Starbucks or Ross Dress for Less. It doesn't matter what the market is. Those companies all find a way of making money, good markets and bad. And so for us, we try to be as disciplined as we possibly can. And if I can't understand how WeWork is going to survive and be successful, it's just easier to learn about it, say that's very nice, I wish you the best, but it's not going in our investment portfolios.
Right, where you have a very high bar for what actually goes into the portfolio to
Correct.
avoid those blow-ups. Yeah, that makes perfect sense. So, Dave, this is fantastic. Thank you very much for all this great information. What are some timeless lessons you've learned over the years that you've seen smart investors or the smart money make, and some mistakes that you've seen the not so smart money make as well?
Number one would be that simple is better than complicated.
Okay.
Our brains are wired to where we like complicated things, and smart people in the investment business like complicated puzzles. And yet sitting down and analyzing a Dollar General store and Dollar General as an investment premise, it is incredibly simplistic. And so usually you will do better with a simple investment as opposed to a really complicated one. And a lot of times people just don't like to do that because, again, they like the complicated nature. What we have found is the more variables that we have to assess, if you're off by just a factor of 1 degree on every variable, all of a sudden you're 500 miles off course by the time you get where you think you're going.
Right.
So simplicity trumps complexity. The other thing is that there is a lot of wisdom associated in owning liquid securities, publicly traded securities, as opposed to privately held things. You never know when you're going to need liquidity until it's not there. It's like oxygen. We all take it for granted that we're going to have oxygen, and you never really think twice about that until it's gone and you start choking.
Right.
And so we've seen lots of people make what probably on paper is a good investment decision, but because they did not have the appropriate cash flow or liquidity backing the investment, we've seen them have to get out of it and dump it for fire sale prices. So, you've got to have the liquidity. You've also got to have the appropriate time frame. Whenever we are working with a client and they're looking at a privately held business, it's got to be at least a 10-year time frame to hold it and make it really work out right. And so, those are a couple of the places where we really see people get themselves into trouble. And then also getting back to how we started the conversation, you've got to have your emergency money. So 6 to 9 months worth of cash, even though it's not going to earn you anything, when something bad happens, whether the transmission goes out on the car, the roof blows off the house because you've got a hurricane, you've got cash to deal with it. You're not having to liquidate a really good investment to go replace the roof. Or if you lose your job, you're not having to have a fire sale type situation.
Yeah, that makes perfect sense. So in other words, you're planning for the unexpected.
Absolutely.
Oh, that's great. So those are some mistakes people make. They overcomplicate things. They look for illiquid investments. They don't have liquidity when they need it, and they don't have emergency cash. What are some timeless lessons, I guess, things that the smart money does well that you've learned over the years, as far as either picking a portfolio, looking at risk? It could be anything under the sun.
So let's talk about risk. So first, let me add in bullet point number 3 to the previous conversation.
Sure.
The debt issue will always rise up and bite you when you least expect it. So again, the math makes private real estate deals look really attractive when you've got lots of debt. But again, the debt can cause things to snowball and it becomes very problematic. And that's true whether we're talking about our own house. There's always a mortgage banker that's willing to lend us a lot more money than we really should. So transitioning forward, let's talk about risk. So in graduate school, we're all taught that risk is a one-size-fits-all descriptor, and it's not. So the class that we teach, every one of my students has to master the concept that there's at least 15 different types of risk that are weighing upon a portfolio in a person's life every single day. And so when we talk about risk, we're really talking about volatility. But if you understand, the time frame and the quality of the business, the day-to-day volatility becomes irrelevant. To us, a much bigger risk is the ability to overcome taxes and inflation over a 10, 20, and 30-year time frame. Because if you look at managing investments for real people, by the time they're 70 years old, maybe 75 at the very outset, their professional contacts have all moved on. Their skill set has eroded. Whatever money they've got to last the rest of their life, that's it. And so for them to be able to maintain their purchasing power, to be able to acquire health care, to get a driver, maybe to have somebody cook for them, that's all the money you're ever going to get. You've got to manage it properly such that it continues to maintain its purchasing power until your last breath.
Okay, that's a really good point. So it's not just looking at the risk from an individual stock standpoint, it's overall look at your capital, look at where you're going to be long term as well.
Correct. And so in trying to manage individual portfolios for real people, having to sit down at our conference room table with them and actually talk to them about how their portfolio is working. One thing we have found, especially after 08-09, is that back in the early 70s, the 4 to 5% distribution rate was championed.
Okay.
And so people said, I can take 5% out and I'm going to be just fine. Well, two things have changed. Number one, if you retire and we immediately go into a 60% downturn like we did in 08-09, you're not going to have enough money to come back out the other side and be able to make your money last. The other thing is, if you go back to 06 and 07, a 10-year treasury in the fixed income market, you could reasonably get 6% on fixed income. This morning, the 10-year treasury is at 1.7, and that's actually up from 1.5 earlier last week. So all of the dynamics of how portfolios are built have changed because of the compression in the fixed income market, in the interest it pays, and at the same time, people are living longer. So since penicillin was invented,
right,
for every 4 or 5 years we are alive, the average lifespan goes up by another year.
Right.
So over a 20-year time frame, the average lifespan is going to go up 4 or 5 years.
Right. So
all of it requires money.
All that requires money, exactly. Yeah. So that's risk from a longevity standpoint. How do you manage risk in a portfolio?
So we try to be very upfront about saying, look, this is how much money you can take out. We are willing to take on the volatility as long as we understand that there are multiple goals that an individual will have in managing a portfolio. So again, some clients hire us just to manage stocks. Most clients, like more than 95% of our clients, they hire us to manage everything. So being disciplined about saying, look, we're going to have some money that's very, very liquid. We're going to have some money that's going to produce cash flow. And then we're going to have a bigger chunk of money that's going to incur a lot more volatility, but we're going to limit our distributions to 3% of the portfolio as a whole. That then allows us to not be nearly as concerned with day-to-day volatility.
Okay, so basically you're looking at the forest and not the trees, meaning the forest is a long-term action in the market. The trees would be the short-term, daily or intraday or even weekly in some cases. Is that correct?
Yeah, and so again, going back to the quality of the balance sheet, back in 08, 09, Walmart fell by 40%. But if you actually took the time to look at their numbers, their sales, their earnings, and their cash flow were going up every single quarter, even though the stock was down 40%.
Got it.
And so if you understand that and you're not hitting your distribution so hard, then you realize, okay, holding Walmart, even though it's down 40%, I will be okay with this investment.
So basically you separate, if I understand you correctly, the company from the stock. And
Sure.
and instead of looking at the stock price to make your decisions upon entry or exit, in fact, you barely look at the stock price. You're more concerned with the underlying company and making sure that they're still checking all the boxes. And then if that's the case, the stock price in some respects doesn't matter because long term it's going to go higher, 10, 20, even 5, 10, 20 years down the road, as long as their fundamentals are in place.
Sure, and that's the key point. Your last sentence. As long as the fundamentals are there, you can be very, very patient. And so when there's 5,000 companies that trade day in and day out in the United States, we're probably only looking at 250 that we will ever consider owning because they display the characteristics of predictable and consistent, something we can understand, something with the appropriate debt level or obligation level, and the high returns on capital and equity. And so once you've identified those, you can be much more patient in building a portfolio. And as long as you communicate that to a client, they're not nearly as worried about the day-to-day vacillations of the market or what the Fed did or tariffs or things of that nature.
And this way you don't have to worry about panicking when the market goes down and selling just because the price is down.
Correct.
Understood.
And that's, we're big believers. We will reach out to our clients very quickly. If the market's down, a sizable amount, we will generally reach out to them very quickly and just say, do you have any questions? Just want you to understand how your portfolio is working. A lot of people are of the misconception that if there's a Republican in the White House or a Democrat in the White House, if the president is impeached, if we have a trade war, that all of a sudden Dollar General is no longer going to sell low-priced stuff, right, or Brown-Forman is no longer going to sell Jack Daniel's whiskey.
Yeah.
If you can take that step back and actually understand what they do, you realize that a lot of noise that is popular for the media to discuss has no bearing upon their individual portfolios.
Yeah, whatsoever. Actually, I'm a big fan of Buffett as well. In his latest report, 2019, at the end of it, he had a great line where he says it's the great American tailwind, where basically, over the long term, market's going up, stocks going up, the economy's going up. Don't fight it.
Correct.
Yeah. The latest headline doesn't matter.
In order to do that, you've got to be patient. And you've also got to turn off the news. And, this is advice that I first started giving to my father, but I've given it to many clients. And that is that I've told my dad he is only allowed to watch 30 minutes of news a day.
Oh, wow.
After that, he has to go hit the golf course or do something productive with his life.
Right. Exercise. Yep.
Beyond 30 minutes of news, there is nothing that's newsworthy. And
it's not even
many of our clients, sit there and just stare at the news all day long, thinking that if the unemployment number was weak in the morning and they repeat it 8 times during the day, that unemployment has gotten 8 times worse.
Yeah, no, I love that. And also the fact that it's not just financial news, it's just news, period.
Correct.
That's great. Yeah, I love that. So, Dave, thank you very much for everything. A few final questions here and then we'll wrap up. What is the best advice you've ever given or received?
I think that there's a lot of timeless advice that is out there. And, one of them goes along the line of, if you want good friends, you've got to be a good friend. Mm-hmm. Your reputation takes forever to build, but it takes minutes to destroy it. And I also think, that fiduciary capacity. So be good to others and they will be good to you. Your reputation is what carries the most weight. It's worth more than an MBA. It's worth more than anything. And, ultimately, we are on the planet to take care of other people in some capacity.
Right.
Wall Street has this horrible reputation for separating people from their money. And in reality, it is a job and a destination and a calling that helps people navigate something that can be very, very complicated and something that is very intimate to discuss with strangers. So much of our job, we are part-time, full-time psychologists, helping people to become comfortable with their money and where they're going. That really puts a smile on my face at the end of the day, knowing that we've helped people to ease their anxiety and fund the rest of their lives.
Yeah, no, it's priceless. It really is. The joy you get from doing your job is just on multiple levels. It's way past the money. So, Dave, what's the best way for people to get a hold of you?
Well, so satherfinancial.com is our website, and my email address is dave@satherfinancial, and our phone number is 361-570-1800.
Beautiful. Well, Dave, thank you very much. You are a very good friend, even though we just met, but I get the feeling you've got that good essence to you. So thank you for sharing your knowledge and your wisdom, and hopefully we'll speak again soon.
Adam, I look forward to it. Thank you for your time.
Likewise. Thank you.